Good afternoon. Welcome to the XM.com weekly market update. And joining me again from Dubai this week is Peter McGuire, the CEO of XM. Good morning, Peter, to you.
And good afternoon to you, Andrew. Lovely to see you. And Dubai is well, the weather's great. It's a fantastic time to visit, and the economy is relatively strong. Tourism's up, and the whole place is very much buzzing. So, if you get to Dubai, this is the time of year to get here.
Very good. All right. Well, let's have a look at some of these numbers. We'll touch on the local market and some Asian markets to start with. Earlier in the week, last week, the Australian inflation rate came out. It came down quite a bit, actually, which was a pleasant surprise, but still hovering just above 4% there. So it is quite sticky and still a way off where the Reserve Bank wants it.
Yeah, exactly right. And that's been demonstrated with policy that's probably going to come out with interest rates in Aussie, and moving forward. Yeah, I think it's 24 is going to be a fascinating year, how it plays out, certainly into the second quarter anyway.
Yeah. And if we look at the Aussie dollar, so that's down also. It's up slightly, but it's come off significantly, particularly on the back of what's happening in the US. So it's recovered a little bit overnight, but still, you would have thought it would have been quite a bit higher by this stage, but still hovering around that 65 mark.
Well, it's been a great market to short since the end of December. It's been outstanding. That all our traders, you put your technicals over that, and it's just been one-way traffic. And, when you pick up the best part of 3.5 cents, it's a monstrous move, leverage it up, and it's been, very, very solid for them.
Yeah. And if we look at that relationship between Australia and China, I know we touched on it last week, the significant issues that are happening in China at the moment. But this chart gives a really good snapshot on, I guess, the Australian reliance on the Chinese economy. So when the Chinese GDP is strong, Australia tends to be the same way.
Exactly right. Then you see CSI 300's down 46, 47% from its highs a couple of years ago, back in about 2021. So that tells me it's a depression, certainly not a recession. And as far as equity markets, and that's certainly not a great sign for us moving forward. And naturally, does, deflation, do they export that to the world? We just need consumers to buy something.
Yeah, that's right. And just quickly looking at that Hong Kong equity valuation, like it's the worst it's been for a long, long time. This chart's going back sort of to 20 plus years. So it's pretty ugly up there at the moment. And just seeing the difference there between Hang Seng and the S&P, it's a huge difference. And the NASDAQ is not even on that chart, which would be even a lot higher. But plenty of issues. Yeah, plenty of issues up that neck of the woods there. Well, staying in Asia, Japan, GDP, another negative result there. So we've got two negative results in a row, which, as we know, is technically a recession, which is very interesting considering the equity market is at record highs.
You bet. That's been extraordinary. The Nikkei 225 over the last year, and you touched 38,000 the other day. Yen sitting at that 150 handle, and where do we run as far as intervention? So, Andrew, it's a very fascinating market to be long or short, whatever your appetite requires.
Yeah, and there's been plenty of commentary this week about the yen, and does the BOJ step in at some stage? So we look at that chart there, a 5-year chart, struggling around that 150 level. So it'll be, I guess we just got to wait and see if the BOJ does step in at some stage.
You bet. That's a monstrous move when you're looking at that window of time from the start of 21 to the start of 24, from 106, 105 to 150. I mean, that's just, and when you compress that down to around about October of 22, all of that change took place in such a dramatic, that 20-month window. It was, nothing short of extraordinary.
Yeah, I know. Over to the US, CPI, it came off slightly, so 3.1%, just back to where it was 2 months ago. It missed only by 0.1%, but the equity markets earlier this week reacted pretty savagely. So any slight miss on any of this economic data, particularly in the US, it can go either way. But obviously, with a slight miss here, the equity markets didn't like it, which translate to, I guess, the interest rates not coming off as quickly as what they first thought.
Exactly. And, the chart tells a story. So we've just got to sit here and watch each month roll out, and we'll discuss that each week, of course. But the consumer, how it's going in the US, and if you look at the Russell 2000, that's probably what the traders need to be conscious of. You can look at your big companies, but also you've got to look at the small to medium-sized enterprises.
Yeah, and I think this chart here is interesting. Now, this only takes into account the Dow, the S&P, and the NASDAQ. So obviously, with the S&P and the NASDAQ, there's been so much influence by the Magnificent Seven, like they call them. But as you said, that Russell 2000, that's been struggling for many years now. And that is obviously a huge amount of those small to mid caps, which are still, they're doing it pretty tough out there at the moment under the weight of higher interest rates.
Exactly. Well, as we said the other day on TV, it's the Magnificent Seven has turned into the probably the sexy 6.25. But if you're looking at that S&P 500, there's 494 or 495 stocks that have performed poorly, and 5 that have been showstoppers. So everything is down to that big push up, and I think traders have just got to be mindful as far as what stocks they're entering and how they trade them over the time frame. Short to medium term or matter of hours only. Depends on their appetite.
Yeah, and I think that particularly in the US, they're really sweating on any commentary from the Fed around the interest rate policy. So, but like we've said a little bit now, clearly March there'll be nothing happening there, and potentially it may be another few extra months before we see any movement at all in the US market on the rates.
Yeah, I think so, Andrew. I mean, look, they're even pushing it out. Everyone I've spoken to in the last week, and we've spoken to all major media across pretty much Asia and Middle East. I'll be with Sky News Arabia in a couple of hours out of their Abu Dhabi studios, and everyone is commenting that, the nervousness as far as markets and the excitement of the market as well. I mean, those opportunities. So you've just got to be, really mindful to, I think, how it's going to play. And from an interest rate perspective, probably July is going to be maybe the first start. We've got to inflation's got to come down. And this is the issue. So I tell you, I think it's going to be an interesting lead up to the election.
Yeah. And the elephant in the room is still inflation, because if that does start creeping up again, then it's a completely different playbook altogether. So we'll keep an eye on that over the next sort of couple of months and see where we land. But good catching up again, Pete.
Yeah, good, Andrew. I'll leave it with this one. 2 things. First off, the Red Sea issue, as far as access through the Suez, is really causing massive issues from shipping. And the second part that we're not conscious of, and we need to be, is since the start of the year, there's been a drought in the Panama Canal, and that's causing major concerns as far as, again, shipping through that access point. So these 2 components are going to raise container costs massively, because they may have to ship around or cruise ships around different parts, and this all fuels into inflation. So, I tell you what, I still think 24 is going to be a very fascinating year. We're 6 weeks in, and there's many weeks to go.
Yeah, look forward to it.
You bet.
Excellent. All right, Pete. Well, stay well, and we'll catch up next week.
I look forward to seeing you in Sydney, Andrew, and have a great weekend, man.
Great. Thanks, Bennett. Bye.